Welcome to the Max Dividends channel, where people build growing passive income, retire early, and live off dividends. Today we're examining American States Water Company, AWR, regulated utility with essential water/electric services. We'll answer, how does this company make money? Is it good for long-term holding? We'll go through Max Dividends checklist step by step, check financial condition, see if it fits our plan, and determine if the stock is undervalued today. How this company makes money. Do I clearly understand how American States Water Company, AWR, earns its money, and does the business make sense? American States Water Company makes money in a straightforward, repeatable way. It delivers essential regulated utility services, primarily water and wastewater, and earns a return set through rate regulation, plus contracted services stream tied to long-duration agreements. Cash flows built on customer necessity, infrastructure investment, and regulatory frameworks designed to support ongoing service and capital recovery. The core engines: regulated water and wastewater. Core utility. AWR's primary earnings engine is its regulated water and wastewater utility operations in California. It invests in pipes, treatment, storage, and system reliability, then earns an allowed return on that rate base through state-approved rate structures. Customers pay for a non-discretionary service, business designed to be steady rather than cyclical. Regulated electric utility, smaller complementary. AWR also operates a regulated electric utility business serving a defined service territory. Like water segment, it's built around infrastructure investment, system reliability, and cost recovery through regulated rates, adding another stable utility-style earnings stream. Contracted water services, U.S. military bases. Distinctive differentiator is AWR's contracted water and wastewater operations on U.S. military installations via long-term agreements. This segment functions like infrastructure services business. AWR operates, maintains, and upgrades systems under contract terms that provide visibility and durability, supported by essential nature of service and quality requirements of mission-critical sites. Infrastructure investment and reliability-driven spend. Utilities don't sell more units like product businesses. They compound by investing capital to modernize/expand systems, improve compliance, enhance reliability. Over time, that expands the rate base and therefore earnings capacity, while regulated model recovers prudent costs and supports ongoing dividend. Key strength: AWR sits at intersection of essential daily demand and regulated infrastructure-backed cash flows. Business model geared toward persistence, not prediction. This isn't complex black box. It's proven utility compounding model where stability comes from regulation, necessity, and long-lived assets maintained regardless of economic cycle. Business model clear, resilient, makes perfect sense. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter: companies with 15 years of consistent dividend growth. AWR crushes it with 71 consecutive years. 15-year chart shows clean stair-step pattern, annual dividends rising from roughly 56 cents per share early 2000s, tens to about $1.94 per share most recently. No cuts, no freezes, just consistent upward progress signaling durable cash generation and disciplined, shareholder-friendly capital return philosophy through different economic environments. That kind of steady, uninterrupted growth is exactly what long-term dividend investors want: elite dividend culture backed by essential utility demand that doesn't depend on fashion or consumer sentiment. Step 1 passed. AWR behaves like true dividend eagle. Step 2. 5-pillar secret formula. First pillar, sales growth. Over past decade, top-line track record shows consistent advancement rather than big spikes/crashes. Revenue steps up from approximately $436 million mid-2010s to approximately $595 million latest period. Smooth climb powered by rate case outcomes, cost recovery, ongoing infrastructure spending, authorized returns, plus tailwind from long-term contracted water operations. No obvious gaps in trend, even with normal year-to-year noise. Revenue continues moving higher, reflecting services customers can't realistically postpone. Sales growth past. Consistent top-line expansion reflects stability of regulated essential service model. Second pillar, profit growth. Profit trajectory even more compelling. Earnings moved higher in largely consistent fashion from approximately $330 million mid-2010s to approximately $450 million lately. Noticeable lift in recent years. Not powered by single lucky break, but by regulatory rate decisions, authorized returns, prudent capital deployment expanding rate base. Few brief plateaus but no major breakdowns. Overall trend upward, recent results near top of range. Exactly what you'd expect from essential service provider whose demand holds up when economy slows. Profit growth past. Expanding profit base strengthens dividend safety. Third pillar, net income. Quiet compounding pattern. Net income climbs from approximately $60 million earlier period to approximately $120 million most recently, effectively doubling after-tax earnings power. Couple softer years, but key signal is recovery/reset at higher level, staying close to highs into latest period. Profitability anchored by regulated frameworks and ongoing infrastructure investment, not discretionary demand. Net income past, steadily rising underlying earnings power, reinforces dividend funded by real profitability. Fourth pillar, dividend payout safety. Payout ratio typically approximately 50 to 60% band. Brief jump to approximately 70% mid-period, but doesn't persist. Recently upper 50% area. Practical setup for regulated utility. Balance growing dividend while retaining earnings to fund system investment, limit financial strain. Dividend structurally supportable under normal conditions, not leaving zero margin for error. Dividend payout safety past. Sustainable utility range with room to compound. Fifth pillar, debt burden. Uses debt as most utilities do, but managed without drama. Debt ratio tight corridor, approximately 0.4 for low end to approximately 0.65 high end. Recent years, low to mid 0.60s. Leverage present, but looks like structural, planned utility leverage for funding, long-life infrastructure, recovered through rates over time. Not emergency financing or balance sheet stretch to protect dividend. Debt burden past. Controlled leverage supporting financial resilience. Company financial condition. Financial score 91, very safe. Strong reading, pointing to balance sheet stability, earnings durability for holding through multiple market cycles. Step 2, past overall, high quality, long-term dividend compounder, clearing each major quality checkpoint. Does it fit our plan? AWR's max ratio of 5.75 places it in balanced Eagles category. 2.84% dividend yield, 51% cumulative 5-year growth, 71 consecutive years, approximately 58% payout ratio, delivers solid income today plus steady climbs. Is the stock undervalued today, cheaper than competitors? No, overvalued versus peers. According to Max Dividend's analysis, market assigns AWR richer valuation than comparable regulated water and utility names, paying up for its stability and long dividend track record. Future returns may rely more heavily on continued earnings execution and dividend growth rather than valuation expansion, with increased risk of valuation cooldown if utility sentiment or interest rates shift. Cheaper than history? Yes. P/E approximately 21.65 versus 10-year average approximately 32.39. Investors currently paying less for each dollar of AWR's earnings than historically. While utilities can de-rate during rising rates or slower growth periods, this metric suggests more reasonable pricing relative to own past, though not automatically a deep bargain. Better yield than usual? Yes. 2.84% versus long-term average approximately 2.11%. Higher than usual starting yield typically signals share price under more pressure or not keeping pace with dividend growth. For dividend investors, attractive because compounding starts from better yield base. though market also signaling caution tied to rate sensitivity and utility sector valuations. Analyst consensus: moderate upside potential. Average 12-month price target approximately $81 implies approximately plus 11.72% return from current levels. Forecast range $72 low to $90 high. Overall neutral consensus with mix of buy/hold/sell ratings. Wall Street sees some room to run, but not aggressive capital appreciation. Fits yield and execution story better than valuation re-rating bet. Final decision: AWR delivers elite quality. 71-year dividend streak. Revenue from $436 million to $595 million. Profits $330 million to $450 million. Net income doubled from $60 million to $120 million. Payout ratio 50 to 60%. Debt controlled at 0.44 to 0.65. Financial score 91 confirms exceptional strength. Currently MaxRatio 5.75 with 2.84% yield versus 2.11% average. High-quality utility compounder at reasonable versus history valuation. Steady, reliable contributor to passive income portfolio. Subscribe for more analysis. This is not investment advice.